And welcome back to Market Shares. I'm your host, Tony Blodgett. And I thought today we would just do a quick update on what's going on with interest rates, what's going on in the market, and what happened on May 10th. So if you watch this podcast with any regularity, you know that it was highly anticipated that May 10th, when April's Consumer Price Index, CPI, report came out, that would be the date that we finally saw some significant reprieve with inflation. And the main driver of that was expected to be shelter costs finally coming down. Well, they've been coming down, but finally reflecting in the CPI report that was expected to be out on May 10th. And look, this has been widely anticipated in our industry. Many of you probably follow Barry Habib. He's been talking about this for a long time. And if you just look at the charts and you look at the year-over-year numbers, it just made sense that we would see a pretty significant improvement with this May CPI number. But unfortunately, I don't want to say it was like a nothing burger, because the market did show some signs of inflation coming down, but not the big move that we were expecting. And there's some reasons for that. There was some revisions to last year's number, which made the drop year over year not as significant. And those were kind of pushed to later in the year. So we still will see the benefit of the year over year drop, but we didn't see it in this April reading that came out on May 10th. The other reason was that in April, OPEC Plus was a reduction in the amount of oil that was being produced. And so that drove up energy prices. And so there's just some things that really made this number, a little bit off the mark where we expected. I got to be honest with you. I personally was hoping for like a big day, like 100, 150 basis point, kind of like when rates went up, we saw them go very quickly. I was kind of hoping that this May report would be that, big jump down to where we could really see in the market that we're clearly into a lower interest rate environment. And the reality is that just didn't happen. And so the question is was it just a miss, or is it yet to come? And I think that what we're going to see as the summer rolls on is you're going to continue to see inflation slowly come down. I think most people would agree that this last Fed rate hike will be the last Fed rate hike. Matter of fact, there's quite a bit of prediction that the Fed is going to have to lower interest rates as many as 3 times in 2023, which means pretty soon, sometime in the third quarter, the Fed may have to reverse course and start lowering interest rates due to, what is looking like a recession that we're heading into. If not, honestly, all the reports and charts that I've seen recently, I would argue that we're in a recession. It just hasn't been called yet. You remember back when everyone, when we had our first 2 quarters of negative GDP and everyone's like, oh, that's a recession. And they're like, hold on, no, there's more to it than that, So I think that you're going to see in the coming months like a formal announcement that we are in a recession, because everything, all the data is pointing to that. So what I expect to see is a slow decrease in interest rates as summer goes on, which is a good thing. I think we're going to see more and more of that, and it's really going to be necessary, because the challenge that we have right now here in the Pacific Northwest, and I'm sure places all around the country, is there's just no inventory. It's really bad. And matter of fact, it's going to get a little bit worse as interest rates get better. As things kind of heat up, if you will, it's like heat up and go where? There's no houses to buy. So then I get worried that might really push up values too quickly and maybe create, some sort of a bubble type situation in the future. Everyone thought when they saw the market cool off in June of 2022 until now, they've been talking about a bubble this whole time. And yeah, we saw, the cream come off the top. We saw a small dip in home values, or at least a drop from the very peak. But we certainly didn't see a crash, and now we're already starting to see them go up. And now there's fears they could go up too quickly if interest rates improve and there's still no inventory. Now, I think once interest rates get low enough, assuming they do, that's going to really help free up some inventory, because what we're seeing right now is that your move-up buyer, the person who was a first-time home buyer 5 years ago, typically would be ready for their move-up home. Maybe they've had kids, they've outgrown their home, they want some more space, their incomes have increased over the years, they've built equity, they would typically be looking to move up. But the problem is that not only are they faced with buying a more expensive home, which is normal in a normal appreciation type market, but they're also having to pay a significantly higher interest rate than the rate they have today. I mean, we know that 60% of current homeowners have an interest rate in the threes, and you add the four handle to that, and that encompasses about 80% of all outstanding mortgages have a 4% rate or lower. And so people are not willing to pay more for the home and a significantly higher interest rate. And once those rates come down, they will be willing to take some of the equity out of their home, buy up or buy their dream home or their move-up home, freeing up some of that lower-priced inventory. And that's healthy. That's natural. We're just not seeing it happen right now. So that's my prediction. I think that, May 10th was not the home run that we were hoping, but it was a bunt, right? It was a bunt that we got on base. Yeah, I wouldn't even say it was a base hit. We got on base. Look, you can't score any points if you're not on base. So it was a move in the right direction. I think it continues to get better. Unfortunately, it may be, due to a recession in the economy, which there are certainly parts of our economy that don't do well in a recession. Fortunately for us, housing and interest rates typically do pretty well during a recession, and the job numbers have been really strong. So unless that significantly changes, we're going to have to see some softening in jobs, or technically they probably won't call it a recession. And we are starting to see that. Hopefully that is not too big of an impact with the employment numbers, because that just hurts families, and we don't want to see that happen. We want just enough so that interest rates get better. But, one thing I want to kind of round out here with is that, one thing that I got to give, Barry a lot of credit, because he always makes great predictions, and at least he's bold, and he's willing to come out and predict what he thinks is going to happen with the market. And one thing that I remember Barry saying in years past, I've heard him say it for many years actually, but as recently as probably 2 years ago, is he said, I doubt that you're ever going to see interest rates above 6% in your lifetime. Now you could look at that and you could say, well, Barry, they were just over 7%, that was kind of a miss. But I don't think that it was a miss. I think that what Barry was saying is that we're in the United States, which is a very mature, developed economy. And it lives on debt, right? We have federal debt. We have municipal debt. We have, corporate debt. We have consumer debt. Everything moves on debt in the United States. And what Barry was saying is that we have an economy that cannot sustain interest rates above 6%. And I believe we're going back to this more, normal market. Matter of fact, as I've been thinking about CPI and PPI and, the JOLTS job numbers and all these little things that we look at week to week, month to month, I think that we're kind of zoomed in a little bit too close, and we're looking at the micro, level. And I think that if we were to really zoom out and look at the macro level of what's going on, I believe what we're dealing with here is still the remnants of COVID. So, COVID happened in March of 2020. And it was like, a tornado that ripped through our economy. And, no one was working, or people were working from home. The hospitality industry was completely wiped out. The feds cut rates, started printing money, buying treasuries, buying mortgage-backed securities, stimulus checks, everything they could do, they put into dealing with this natural disaster, if you will, that was happening to our economy. And so if we're still kind of zoomed out, you can see this kind of tornado rip through. And then there's going to be a tailwind to that. There's going to be the remnants of that we're going to take time to heal. And so although I think we can look at the week-to-week, month-to-month numbers to give us an indication of what rates are going to do week-to-week or month-to-month, I think if we zoom out, I think what we're headed for is a very similar market to where we were in 2019 before COVID hit. You know, the end of 19, the beginning of 2020, we were heading for a recession, and we had a low interest rate environment. And so I think that we're going to get back to that sort of a status quo is my guess. Now, it doesn't mean that we won't continue to have to look at what the economy is doing. What are the jobs numbers doing? You know, these things are constantly moving and driving both the stock market, the bond market. And yeah, we need to continue to look at those. But I think we lose sight a little bit of the big picture. And the big picture is we're still just post-COVID. And we're dealing with all that happened during that time. And we're going to for a little while. But when things calm down and we get back to, you know, homeostasis, it's low rates. That's what our economy needs. Now, doesn't mean they can't be up in the fives at some point and down to the threes at some point, but that's kind of the range. I think Barry was right. Had we not had COVID, you probably never would have seen rates over 6% in your life. I believe that to be true. And I think that COVID was an anomaly. It was unforeseen. It was a black swan event that no one saw coming. And as a result, we got an economy that just does not follow normal rules. And it's going to get back to normal. So you guys, that's my thought for today. I didn't get too much in the details of all these reports coming out because I really wanted to get the big concept across, which is, look, I still think May 10th was the tipping point. Rates, it's very obvious to anyone who's watching that inflation is coming down. There's no question about that. So as goes inflation, so goes interest rates. Might take a little bit longer than we thought, but that's the direction that we're going to go. So stay in the game, be ready to, you know, help your clients with their transactions, but be ready more than ever to refinance some people when the opportunities come. You know, really stay in touch with your database. Make sure you're cleaning up your database and you're ready to help people when the time comes. And don't forget about cash out refinances. Look, that's a huge missed opportunity for those of us in the retail mortgage space. I promise you, the call centers are calling your clients right now, offering them debt consolidation and cash out refinances, and many of them need it. They need it. Like, we think, like, why would you get rid of that amazing interest rate that I gave you? But you don't know what's going on in the rest of their life. You don't know what their car payments are or what their credit cards they may have racked up over the last year. We need to be talking to our clients and helping those people who need to tap into their equity. Don't be afraid to have those phone calls because it is a huge opportunity. And that just gets more and more easy to do for a client as interest rates get lower. So with that, you guys, thanks for taking the time to watch Market Shares. I hope that you enjoy the content. And if you do, tell someone about it. That's all I ask. You know, tell a colleague, someone else that you think might benefit from the information that we put out every Friday at 10 a.m. We drop a new episode. And if you haven't already liked and subscribed, please consider doing so. And until next time, bye for now.